Welcome back to another episode of Not Financial Advice. Today is Tuesday morning, February 20th. And on today's video, we're going to be talking about prospective investments in three companies: Uber, Chewy, and Airbnb, under the framework of new consumer stocks for the 21st century American dream. I'm going to lay out my case for these stocks and also give you a quick update on how my portfolio is performing right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Well, all right. Tomorrow, the market is looking forward to the report card from NVIDIA. And there's also some financial reports and meeting minutes from the Fed that are coming out here later this week. And so that's certainly, I think, driving the sentiment in the market today. The market is not feeling very good about risk at the moment. It's pretty risk adverse. Today, my portfolio is down 0.61%. The market is down a little bit more than that. And so the types of stocks that are doing well today for me, the top five performing investments are going to be Mexican Coke, up 2.3%. Up 2.3% as well is Kraft Heinz. Regular Coke is up 2.1%. Foot Locker is up 2.1, and Pepsi is up 1.9. So certainly more defensive and value type stocks are doing well today. But looking at the bottom five decliners in my portfolio, you can see that risk off sentiment: Coinbase down 6.6%, Tesla down 4.2%. We have Cureleaf down 3.5%. Williams Sonoma is down 2.1%, and Netflix is down about 2%. And so that brings us to the topic of today's video, looking at some different investments as 21st century consumer stocks for the new American dream. And so, I want to paint a picture here for you. What we can see on the left is, an image of the 1950s. This was real life for a part of our population back then. Not everyone had it as great as this, but the reality of that circumstance was that families bought new vehicles, they went on vacation, they either drove across the country or they flew, and they would go to hotels or resorts or overseas. They might pick up a picnic basket and take that for a trip. At the same time, a newlywed couple might take a plane to Paris and stay in a hotel and visit restaurants, and they would take taxi cabs to and from the airport, things of that nature. And so, fast forward to today, a lot of things have changed, but a lot of things have also stayed the same. And so, just one note, um, you know, the adoption of pet ownership has really increased quite a bit just in these last 4 years. But, people are spending on experiences. And people are more suburban or urban than they are rural. And while they still, go on vacation, um, they're less often staying in hotels and more often getting an Airbnb. They're not taking a taxi to the airport. They're taking an Uber. Or, they may take a train or a plane to a vacation destination, but then instead of staying in a hotel, they're in an Airbnb, and they're using Uber to get back and forth. And so, I guess the premise for the video is some of the best stocks have always been those that are twofold stocks with, sort of an exposure to technology, but also some stocks that have a pretty close, relationship to the consumer. And so I want to look at Amazon stock. I'll ask you to like the video and subscribe to the channel. But there's a couple fold lessons we can take from this. So first and foremost, there's never a rush to get into a great investment. So when we look at this stock, it went public in about 1997, and it went up a tremendous amount, in those first 10 years, about 5,000%. But if you sat out Amazon being public for the first 10 years, you still had a return of, over 5,000%. So that's first and foremost is there's never a rush to get into the right investment. Okay. But also we can see here a stock that's powered by technology, but one that has a grasp on the consumer. And so we can see the same story here with Microsoft. It did really well from 86 to 96, undoubtedly, up 6,000%. But if you sat it out for the first 10 years, again, because there's never a rush to get into the right investment, you had returns around 6,300%. And so, this sort of sets the framework nicely for our conversation today on these new stocks for the 21st century American dream. And the more that things change, the more that they stay the same. But when we think about Uber, we just saw that they've unveiled a $7 billion share buyback program after their first profitable year. And so, a couple notes on Uber. I think that there's also Lyft, but I think at this point it's become clear that Uber is the dominant ride sharing business. Um, they've just also launched Uber One, which is a subscription model that a lot of urbanites are, really enjoying because they save money on their fares, but then they also can get lunch delivered at the office. And Uber's also, getting into grocery delivery. And so think about back then versus today. Uber is not only a replacement for taxis, it's a replacement for, um, Pizza Hut delivery. It's a replacement for the friendly neighborhood grocer that would drop off an order of groceries. It's all of those things, um, but pretty capital light and pretty technology based. And so you can just see all these different elements that have always been and always will be part of society, sort of wrapped together in a portfolio, with a pretty neat company and one that's starting to show some promise. And so getting into Uber stock, it's been public for about 5 years, done pretty well over that time. But there is certainly, I think, a lot of future growth in front of this company. And, that brings us into Qualtrim, which is a software service I pay for, not one I'm affiliated with. I'm going to leave a link for Qualtrim in the description below. But another thing about, investments, evergreen sort of tomes about investments is that, a good investment has not only profits today, but a greater amount of profits that can be seen in the future. And by definition, if a company is not profitable, it's speculative. And so we're seeing that sign of maturity with Uber with its share buyback program. But let's take a look a little bit deeper into this stock and see what we can learn. So, looking at Uber Technologies, it's 163 billion market cap stock. It's the largest stock of the ones we're looking at today. So it is a large cap, but it's not a mega cap. It's not one of the most dominant companies in the country yet. I think that market cap will expand if they continue to grow revenue and profits as they've done. But you can see a forward PE of 61, which is pretty high. So the market is looking for a lot of profit from this company in the future. And the question is, are they starting to deliver on that? And so we can see adjusted for stock-based compensation, they have a nearly 1% free cash flow yield, which is pretty low. So the company is definitely expensive, but let's start getting into some of our checks and minuses on this company. So looking at Uber and thinking about everything that it represents, here's how it's doing on the revenue front. Really strong growth. Over the last 5 years, they've averaged 27% a year revenue growth. And that is undoubtedly a check mark. Very, very stronger growth than the average company in the US stock market. So Uber is growing top line revenue. And now the question is going to be about free cash flow. So the first thing that I want to look at is the fact that, nominally they posted $3.4 billion of free cash flow for the last 4 quarters. Um, but the picture is a little bit more murky. So they're doing a lot of dilution. Um, you know, Even in 2022, they posted free cash flow, but they rewarded executives with 4 or 5 times as much free stock, essentially. And so, you don't like to see that. And that's something, and just another disclaimer, I don't own any of these companies. I don't think I'd buy any of them just today. But you can see that they've overtook their stock compensation program with free cash flow this year. And so we should be looking at everything adjusted for free cash flow. And so now that number's lower. Now it's $1.4 billion of free cash flow over the last 4 quarters. And so, that's not nothing. It's pretty good. Let's look on the quarterly basis. Look at the free cash flow on Uber on a quarterly basis. Let's look over the last 3 years. And so, adjusted for stock based compensation, we can see that these losses have declined. They had shown some promise in the past, and there's sort of a trend reversal going on here and a big year of a decline. But then now we're seeing 4 quarters of positive free cash flow growth. So I'm going to give it a tepid check mark, but it seems like they're not really having too much of an issue doing about $300 million a quarter in free cash flow. And so that's looking pretty good. I'd like to see, maybe another couple quarters of that continuing, but it seems like the company is profitable. So, like the video, subscribe to the channel. Let's take a look through the rest of the metrics on Uber to see if this could be a prudent investment. Looking at earnings per share, it's really ugly. So positive in the last 4 quarters. So I'll give it a red X. And looking at cash and debt, what we can see here is that their debt is growing and their cash is declining. So that's going to be another red X on Uber. Looking at shares outstanding, they're diluting shareholders. They did just announce their first share repurchase program. So I guess if they're going to repurchase shares, we could look forward to this trend reversing. So I'm going to give it a check mark based on the news that we have, a positive sign. Looking at their profitability metrics for Uber, they have a negative return on capital employed, which is pretty remarkable, but it's moving in the right direction. So I'll give that a neutral rating. And looking at their bottom line profit margin, they have one now. So 5% isn't great. And it still looks a little bit murky here, but I think the subscription revenue is going to really do wonders for this company. So I'll give this one a neutral rating. But let's take a look at. I don't think we're going to be able to learn a lot from its PE valuation because there's been periods with negative PE earnings. But looking at expenses, we can see that the expenses are going up and to the right. So that will be a final red X for Uber. And so, we're just starting to see a company that's becoming mature and moving in the right direction. And there's not a rush to get into it, but I think this is going to be a continually larger piece of American society and, one that I would consider for investment. I think it's very interesting. So let's go on to our next stock, which is along the same vein. And I've sort of described it in that narrative, Airbnb. Um, their stock is flat over the last 4 years. So, uh, one thing that I think is interesting is it's in a little bit of a bullish pattern here, up about 61% in the last year and a half or something. And so that seems positive just from a price action standpoint. But again, when we're thinking about Uber or Airbnb, rather, it's a lot cheaper to run an app than it is to run a hotel, right? And so this is going to be $100 billion market cap stock. It's a large cap, not the largest of a large cap, but they're working with some free cash flow here. They actually have a pretty nice free cash flow yield of 3.4%. That's better than I thought it was going to be, and uh, relatively believable PE ratio forward of 33.4. So this actually is a little bit more interesting to me now that I'm really looking at it in our video here together. Top line revenue growth, 22% a year. That's pretty fantastic. That's going to be a big check mark for Airbnb. Let's take a look at what else we can see here. Free cash flow. How much are they paying themselves in stock? Not as bad. So this chart actually looks really good to me. I'm going to give them a check mark on free cash flow. Looks like they're doing about $2.5 billion of free cash flow pretty pretty easily. They had that big jump there, and then they've continued to grow it. So a check mark on free cash flow for Airbnb. I am kind of impressed. Let's see what else we can see. Earnings per share, a little bit of a trend reversal here, moving in the right direction. I'll give them a check mark on earnings per share. Cash and debt, if this data is right, looks great. So this is just becoming more and more interesting. They've got more cash than debt. That's awesome. That's really good. So a check mark on cash and debt. Let's take a look at shares outstanding. They're diluting shareholders here modestly. So I'll give it a red X because they're not even or going down, but this is better than I would have expected. Looking at ratios for return on capital employed, that's a pretty impressive number there, 22%. They don't really have this track record of establishing it, but again, a little bit of a trend reversal here, and that's moving in the right direction. So very, very promising. Let's see if they make money. Looks similar to sort of our previous one we looked at with Uber here, but look at that bottom line profit margin of 22.5%. So that's just 4 quarters worth, but that is looking promising. I'll give it a neutral rating because it's not necessarily established. But again, there's Airbnb and who's their other competitor? I can't immediately think of who it would be. VRBO. Airbnb is the dominant player in this space. And so, that's another thing you need an investment is a company that's going to be here in 10 years. And on all of these companies, I believe they're going to be here in 10 years. And that's why now is the right time to start looking at them. So, yeah, a neutral rating on their bottom line profit margin. It's looking really good. And then expenses are going up into the right. So that'll be a red X. So this is the one that I'm most interested in. I might do a standalone video on this, but let's get over here and take a look at Chewy. So I first was drawn to this stock. My best friend's mom has ordered through Chewy for the longest time, and if you think about it, it makes sense. And I really want to get some exposure to the pet space. I think it's probably described as consumer discretionary, but it's not. I think it's a consumer staple. I think it's defensive. I think it's durable. I think no matter what, some people, you'd want to feed your dog as much as you want to feed yourself, and if you were hungry, you'd split your meal with your dog. Just love dogs. So their stock is down 52% from all times. That potentially could be attractive. Let's see what's going on with the company to see if there's anything that informs that. So this is going to be a mid cap company, so less than 10 billion. Potentially could be some pretty good upside on it. A really high forward PE of 68, so pretty dang expensive. Market's looking for a lot of future revenue growth. And this revenue growth chart looks fantastic, 24%. So right in that low 20 range, just like our other three companies, that looks really good. That's going to be a check mark for Chewy for top line revenue growth. Let's see if they make any money. So they have a free cash flow yield of 1.25%. See how much they're screwing over shareholders horribly. So just based on this alone, I can't. I want to invest in the company, but I can't. One of the things about this company, so they don't have any free cash flow, so it's a red X. That really sucks. One of the things about this company, they write condolence letters if you stop ordering pet food for your cat. If they have terrific customer service. Really no questions asked, returns. They're very in tune with your pet, and they know how important your pet is to you. You know, a very human company in that sense. Really a lot of things that I like about the company, but not things I'm liking about their business practices or their stock. Looking at how they don't really have free cash flow or earnings. There's 12 cents of earnings for 4 quarters. It's a little bit of a trend reversal. I'm not overly impressed. Give that a neutral rating. Cash and debt. It's saying that this company doesn't have any debt. I mean, if that's the case, if this is accurate, um, I'm going to give it a green check mark. I'll do some research. If I find out they actually have debt and this data is wrong, I'll leave a note. But here's our first check mark for Chewy. So it looks like they've got a cash pile. That's a good thing. Let's see if there's anything else they're doing that's remarkable. Keeping shares pretty level. And yeah, keeping shares pretty level. For this type of company, this is pretty good. I'm actually going to give it a check mark. Yeah, I'll give it a check mark. So let's take a look at returns on capital employed for the company. It's getting worse. I'm not sure if that was right. Give that a red X. A little bit of a reversal. They're starting to be more and more profitable. Super low margins, though, on bottom line profit margin. I'll have to give it a red X. And ramping, steeply growing expenses. So this one's quite a bit earlier, you guys. That'll be a red X as well. So, that concludes today's video, and it's just a way to think about things through a different lens. I think I've laid out the case. I'm most interested in Airbnb, but Uber is looking promising as well. Chewy needs to do a better job. But yeah, if you own any of these companies or if you're a customer of any of them, if you have any other thoughts or questions, feel free to leave a comment below. Thank you so much for stopping by and taking a look at my video. On the way out, like the video, subscribe to the channel. I'm Sean, and I'll see you on the next one.